This is the Future of Finance.
Hi, everyone. Welcome to the Future of Finance podcast, where we explore how finance can shape a sustainable economy. I'm Georges Dyer, and today I'm really excited to be joined by Fran Seegull, president of the U.S. Impact Investing Alliance. Fran is a leading voice on impact investing, and the Alliance is a critical field-building organization in the space, working to strengthen the ecosystem through public policy advocacy, catalyzing institutional capital flows, and building the broader impact investing movement. Before leading the Alliance, Fran served as the Chief Investment Officer of ImpactAssets, where she oversaw now $3 billion impact investing donor-advised fund. And she taught a graduate-level course on impact investing at USC's Marshall School of Business, where her students awarded her the Golden Apple Teaching Award for Best Elective. So she clearly knows how to make this material engaging. We dive into the current state of U.S. corporate governance and what Fran sees as a troubling shift from shareholder primacy, not to stakeholder primacy, as many of us had hoped, but to what she describes as management primacy. We also talk about system-level investing and why it's so important and how it's gaining traction as more investors recognize the limits of modern portfolio theory in the face of systemic risks. We dig into Fran's recent policy outlook for 2026, covering everything from community investing, efforts to protect the freedom to invest in ways that recognize the material, social, and environmental risks that we face, and the rollback of landmark climate policies. And we discuss the impact measurement and management aspects of all of this, including some frameworks that every asset owner should have on their radar. It's a great conversation. I really appreciate Fran for joining us, and I hope you get a lot out of it. Please let us know what you think by leaving a rating or review. And now here's my conversation with Fran. Hi, Fran. How you doing?
I'm well, George. Hello, how are you?
I am great. It's so good to see you. Thanks so much for doing this. We're excited to have you on and learn more about your work.
Oh, I've been looking forward to it.
Excellent. Well, why don't we start for people who might not be familiar with the U.S. Impact Investing Alliance and just share a little bit about what it is and how it came to be.
Sure, happy to. So I lead the work of a nonprofit project called the U.S. Impact Investing Alliance. And we're a field-building organization. So we seek to build the field and the practice of impact investing with the goal of helping to manifest a more sustainable, equitable economic system. And just to level set, because different people think about different things when we use the term impact investing, and we at the Alliance use it very broadly to be focused on the pairing of impact factors and financial returns across asset classes, across geographies, and across risk-return profiles. So we look at public markets all the way across the asset class spectrum to real assets. Mm-hmm. So for the purposes of this conversation, I'll be speaking quite broadly.
Yeah, I think it's such an important clarification because there are so many different understandings and even definitions. And just for our audience, like some people will think that impact investing necessarily includes concessionary returns, or it's only in private markets, or it should be when we use that word, some specific mode. And we tend to think of it the same way, almost like all investing has impact. So thinking about that impact in any asset class, whether it's deep impact or light impact or sort of an influence or a direct outcome, is kind of how we think about it too. But that's helpful. And I think just for people who may not be immersed in these conversations like we are day in and day out, it's good to let them know why that might be confusing.
Yeah, and you are touching on a statement that I believe Clara Miller, the former president of Heron, said, and she's such a author of pithy statements, but so it was an instant classic. She said, all investing is impact investing. And we believe that's true, that as you said already, George, that all investment has an impact, but that the impact is largely or completely opaque to stakeholders, including shareholders. So, I love the name of your podcast, The Future of Finance. When we founded the U.S. Impact Investing Alliance back in 2016, we said the future of investing is impact investing. So all circling around similar approaches and orientations. In terms of the origin story, I'll make it brief about the Alliance. So Darren Walker, who was then president of the Ford Foundation, recruited me to co-found the alliance with him, offered a residency at the Ford Foundation that lasted 4 years, actually. So it was a wonderful opportunity to work closely with a very dynamic leader and advocate for impact investing, which we did, and we had subsequently spun out. And again, the goal was to build the field and practice. At the time in 2016, we were focused on just moving more dollars for impact investing. And I would say our theory of change, to use a non-profity turn of phrase, started shifting in, I would say, 2019 and certainly solidified in 2020 into 2021 when we were experiencing the poly crisis. That we shifted our perspective, George, from impact investing for impact investing's sake to, why are we engaging in impact investing? And so we started focusing more on the unique role that impact investors have to play in again helping to manifest a more sustainable, equitable economic system. We work across 4 main pillars. So these are like the tools that we use to try to effectuate change. The first is advocating for an enabling public policy environment, mainly at the federal level, which is admittedly difficult at this time. I'm happy to talk about that a bit later. Second is catalyzing investor action to drive more capital for impact. The third is this movement building, communications, narrative building, and we've partnered with IEN and other organizations on that, trying to focus more on real-world outcomes and articulating the real-world outcomes of investments. And then finally, we pool donor grant funding to support projects that we believe will fill market gaps, will catalyze the growth of our field and practice with impact integrity. And we're a proud funder of IEN, which we can talk about later. So those are kind of the tools that we use to try to move the dial.
Yeah, that's great. Thanks for that. I mean, in my mind, I sort of think about you doing direct work as you laid out and also kind of serving almost as like a network facilitator in some way. And remind me, like there's sort of there are international counterparts, right, that aren't formally affiliated, but similar kind of models in other countries that you work with too?
Yeah. So we are the U.S. representative to the Global Steering Group on Impact Investing. It's now been rebranded GSG Impact, and now there are more than 50 country representatives throughout the world, the majority in the Global South, actually, which is so exciting. So I always feel like it's the United Nations of Impact Investing with a U.S. representative. And what's fascinating is that for a number of years, say, 2017 to 2020, 2021, when we would have these share outs and information exchanges with alliance equivalents in other countries, it felt like, the U.S. is really leading, and others, UK, maybe Japan. And what has been so fascinating, given the headwinds that we'll likely touch on later, that we have been experiencing in the United States, starting in 2020 to present, we have. I don't know that we're leading anymore as a country, and that has been sobering and distressing.
Yeah, well, it's too bad given all the resources we have and financial, intellectual capital, everything else. But I guess the bright side of that is the growth in other parts of the world, picking more of that up. So what are some of the things, I don't know, within those pillars that you're kind of most focused on right now? Like what are the top priorities that you're zoning in on?
Sure. We have felt like this is a time for reflection, 2025 into 2026. The term impact investing was coined nearly 20 years ago, and we felt that it was important to take a step back and say, yes, the field has grown. Yes, the practice has become more mainstream and indeed more sophisticated, but also to acknowledge that the challenges that we're seeking to address collectively are larger, they're more complex, they're more interrelated, and they're more expensive to solve. And so we are trying to candidly reflect on, is impact investing fit for purpose? And do we need to be broadening the aperture a bit to focus more on system transformation? And so the Alliance right now is seeking to balance our near-term goals and our long-term goals. And in 2025, moving into 2026, we developed and started operating with these 3 different modalities. And that has helped me and the team show up in different fora with different tools, different postures, perhaps different language. So the first is rapid response to the anti-impact attacks in order to defend the progress that we've made in the field over the last nearly 20 years. So, for example, we've worked with Ceres and many others on defending the so-called freedom to invest, and meaning the ability for investors to consider financially relevant impact factors in their investment decision making. The second modality is, where can we find small stackable wins? And to say small, it doesn't mean that they're not meaningful. They're meaningful stackable wins in the current operating environment that will enable our field to advance and our practice to advance at this time. And an example there would be some incremental public policy wins, such as the support of the tax and spending bill for community investing tax incentives. Another example is there's a live piece of legislation to create a small business investment vehicle focused on ESOPs, employee stock ownership plan conversions. There's a constellation of public policies and private sector actions focused on the silver tsunami, and how can we, as a generation of small business owners retire, how can we shift equity ownership to employees to address income and wealth inequality? So, those are meaningful wins that we can then build on. And then finally, how can we keep our eye on long-term gains? Meaning laying the groundwork now for more transformative progress in the future. And here I'll just quickly lift 2 areas of work that we have. One is recentering and more effectively communicating the real-world outcomes of investments. Yes, impact investments, but all investments have real-world outcomes, and moving away from kind of the pure financialized economy to one where we're more rooted in real-world community outcomes for people, for families. So looking at, clean air, clean water, kind of we consider basic human rights, healthy, thriving communities, resilient communities. So that's one cluster of work with the eye on the long term. And the second is, and I know that you have been exploring this quite a lot at IEN and with different guests, but the increasing recognition and uptake of system-level stewardship frameworks that consider portfolio-wide risks like climate change and income inequality.
Yeah,
that's how we're showing up.
That's great. I want to dive into several of those things. But first, kind of that, I was going to go to that system level piece because we have been talking about it. It's been fascinating. I mean, I think there is a real awakening in this moment of great disruption, or these years of great disruption. And I think, recognizing those community impacts, but also like the text, we've been doing more around responsible AI and just the tech impacts of people being increasingly isolated and disconnected, and sort of really coming back to like, what is the point of all of this if these are the outcomes we're getting from some of these technologies. But anyways, yeah, like climate inequality, I think some of the social isolation, like that can lead to breakdown and impact the value of portfolios across the board, I think is something that we've been really leaning into as well in terms of helping investors think about how they can address that. And I feel like we as a field, and some of the folks I've had on the podcast, Bill Burkhart from TIP and John Lekumnik and others, and it's a kind of a fun time to be exploring all this and figuring out what the best tools and frameworks and approaches are. I mean, a lot of those folks have been working on this stuff for years, if not decades, but it feels like a lot of it's kind of coming together right now. So, I mean, do you have a sense, is that kind of where you all are at right now too, or do you have specific activities going on that'll help elevate that whole field?
Yeah. So we, for 5 years, ran a donor collaborative called the Tipping Point Fund on Impact Investing. That was a grant-making entity where roughly a dozen donors came together and pooled their grant capital, some of their grant capital, to engage in collaborative grant making. We did a field analysis. This was back in 2019, where we looked at the field building functions that allow any field to emerge, and realized, then we did a donor survey, and we realized that there were two key areas of grant making that were underfunded, inconsistently funded, and or would make sense to fund together. And so we focused on, the first was data metrics and measurement, and the second was public policies. And there's absolutely a Venn diagram of areas where we certainly funded public policy around impact disclosure from among corporates and asset managers.
Mm-hmm.
We did fund a cluster of groups, the ones you mentioned: Pre-Distribution Initiative, Rights Collab, Sinclair Capital, which is John LeComic's shop, and a number of others, the Shareholder Commons. As well.
Founder.
Yeah, exactly. So we started funding that, I would say, in like 2020, and felt like there was some real potential. There was excitement and potential traction, and felt that, and still feel that, the system level frame is a potentially potent bridge between traditional finance and impact investing. And what I mean by that is that a system level frame, so for traditional investors, acknowledging the interconnected nature of our social, economic, environmental, democratic systems, how they impact capital markets, how they impact the real economy, for universal asset owners, for widely diversified owners that effectively own the market, that system level risk, as you've touched on many times on the podcast, is non-diversifiable. It cannot be addressed by security and asset manager selection alone. And these are risks that permeate an entire portfolio, and cannot be mitigated with traditional asset management tools and asset allocation tools. So we still see, although you're right that the OGs of system level investing have been at it for a decade, we still see it as a somewhat nascent but growing and very promising movement. And we were calling on investors to use all the tools in the toolkit to protect the systems on which their portfolio returns rely. And there are a lot of tools that they can use, from portfolio construction, capital markets assumptions, asset allocation, manager selection, engagement with asset managers and selectively portfolio companies, working together to set industry guardrails, public policy engagement, and my personal favorite, which is a very hard sell for pure financial players, but grant making to support the field's infrastructure, because we really need not just the research, but also the products and the tools to make system risk mitigation and system risk and system opportunity investable. So we have been funding this. I've been speaking about it more and more as the system level investing and even dynamic materiality as important financial return rooted frames by which we can entice traditional investors to the table to consider financially relevant impact factors. I equally think that, if there's a critique of impact investing, it's that we're tinkering around the edges of a broken system. And one of the manifestations of that, and we see this with foundations and sometimes with high net worth families, is there is a deep impact investing carve out.
Mm-hmm.
And I hope that the system level frame is a way also to draw more pure impact investors to pay more attention to their corpus. And so in that way, I find it like this potent draw for both sides that sometimes don't talk to one another.
Mm-hmm. That's a great point. And yeah, I want to pick up on a few things. First, that's a great articulation of system level investing. And I think it took me a while to sort of really wrap my head around it. And I feel like I've been studying and working in systems thinking and sustainability for a long time. So that's a big part of why I want to keep having more guests talking about it, because it does take a few iterations, I find, for people to for it to click. And I couldn't agree more that the potency, as you say, for, kind of addressing some of these core issues is really there. And I just want to say that the funding network, I think, I don't think that's a coincidence that a lot of those folks that have been working diligently on this for years, it's starting to really get more traction and build momentum as a result of that over the last few years. And I'm sure that sort of support is not unrelated because, that's how some of these ideas get out there. It's kind of like some of that's those softer activities that are probably harder to measure and stuff for grant makers and funders, but I think are so critical. Obviously, as someone who runs a network, I'm going to say that. But that's really valuable to help get these ideas to get traction and keep improving. I want to pick up on a couple of specific things that you threw in there. One was the CMA's capital market assumptions. Can you just talk a little bit more about what those are and how that relates to system level investing?
Yeah, so capital markets assumptions are a set of assumptions that an asset owner will make about everything from geopolitical risk, country risk, foreign currency risk, implications of cost of capital. I'll give you a system level example. The cost of capital should be going up for financing fossil fuel entities. So using capital markets assumptions to reward good impact and system actors and deprive capital of those that are, being extractive in either social, economic, or environmental ways. And so thinking in I think system level investing invites asset owners and other field actors to be looking more holistically at the constraints of our planet, the social and economic constraints of our society, and understand the implications for investment. Not just, how we talk about double materiality for corporations, where many corporations are most interested in what impact factors are, like, water scarcity, for example, what the financial impact is to their business model and their supply chain. Double materiality asks also to understand what social, economic, and environmental impacts they are promulgating on society and the environment. And I think that kind of approach to double materiality is important to think about around system level investing. So, and I think if that can factor into capital markets assumptions, what systemic factors are impacting your portfolio, and which are you manifesting? Like, what is the collective financial and impact of your portfolio, and how are you rendering impact on those systems so that it's circular? It's not one. I feel like financial relevance is something that we have to dwell in that language, George, of like, what's financially material, what's financially relevant, how can you mitigate risk? But the truth is, it's more complicated than that, and it is circular.
there's an interplay, and investors have impact on the world. And I would argue a lot of influence and impact on the world.
Yeah.
If it's fully leveraged. But I think that's an important concept because it is, as you laid out, kind of a traditional concept for investors. Think about capital market assumptions, and then looking at how some of these social and environmental factors should be integrated into those, right? If it's pricing carbon, or as you say, what the cost of capital should be to fossil fuel providers and things like that, I think can help traditional investors maybe integrate some of these system level concepts. And then another term that I'm not sure if I heard you correctly, but did you talk about dynamic materiality also?
Yeah. So traditionally we think about financial materiality, and the concept of materiality is, set by the courts and practiced by the SEC, presumably, and companies in their disclosures, in their filings and formal disclosures. So when we think about environmental, social, and governance, ESG factors, the SEC says that if a factor is material, whether it's ESG or not, you need to disclose it in your 10Ks and other filings. And there's a certain set by industry, formerly SASB, now the International Sustainability Standards Board, which is situated within the IFRS Foundation, which sets accounting standards for over 140 jurisdictions in the United States, ex-United States. So it's basically like the globe, ex-United States. And we report according to GAAP, and everyone else reports according to the International Accounting Standards Board, IASB. So now there is an International Sustainability Standards Board, which is the formerly SASB and IARC and the Carbon Disclosure Project, all kind of merged in together, and are setting the standards for financial materiality impact factors by industry verticals. So, for example, like for a beverage company, water is financially material. It's like a simple example. And so financial materiality is easier to make the case for at the SEC around corporate disclosure, internationally at the EU, which has a kind of a higher disclosure bar, although some of those standards are getting diluted as we speak. Then there's impact materiality. So that gets back to, the circularity that a company, there are impact factors that affect a company, and some of which are financially material. And then there are the impacts that a company renders on communities, supply chain labor, workers, the physical environment. Mm-hmm. So there's impact materiality, there is financial materiality, then there's something called dynamic materiality, which is those factors that may not be material now, those factors that may be impact material now, but that over time, given the realities and constraints of the world, will become financially material. And, all you would need to do is think about climate and the rising constraints of climate to say, there are plenty of climate-related impact factors that over time will become financially material. We actually do a lot of our work around the S, kind of the people focus around ESG disclosure. But anyway, this idea of dynamic materiality, like impact factors are in the future will become financially material, is also a compelling bridging concept, I think, in the same way the system level investing is. So anyway, that's a long answer, but.
No, it's helpful though, because you had to lay all that background, and I don't think I had heard that phrase before. But yeah, it's kind of explicitly identifying that temporal time aspect into the materiality conversation. Very cool. Well, I'd love to. You talked about policy kind of being one of the pillars, and you wrote a great piece at the end of last year about 8 policy areas kind of in focus for impact in 2026 that you thought would be important. And you kind of mentioned some of these. That one is around, well, those 8 are in 3 categories. One category is community investing. Second is that attacks on the freedom to invest, which you mentioned. And then the third round kind of backsliding on climate policies and the impacts of that. So we'd love to dive into each of those 3 just a little more in depth. And starting with the community investing, you've been doing a lot of great work on the policy side of this. Talk a little bit about just kind of the basics of the Community Redevelopment Act that's been around a long time, but it's going through some changes, the CDFI fund and some of those other pieces that you focus on.
Yeah, so the community investing ecosystem is unique and strong in this country. And the community CDFIs, community development finance institutions, community banks, which are depository institutions, credit unions, these are all call them capillary financial institutions because they reach into at times hard to reach communities in the United States. And these are constituencies that maybe are unbanked or underbanked. And so it's really about financial inclusion and access to capital issues, both personal loans, personal financial products, and small business loans, nonprofit loans, affordable housing. It's a dynamic and highly distributed piece of infrastructure that is important to not just defend, but to support. And it gets a big boost from the Community Reinvestment Act, which was passed in the late 70s and had been revised a couple different times. And what that says is that banks, in order to be in good standing with their respective supervisory agencies, so that would either be the OCC, the FDIC, or the Federal Reserve, need to invest in the communities in which they have branches. And so that is meant to combat something that was very prevalent in the 70s and frankly is prevalent even today, called redlining, where it is literally, there were maps on the wall and someone would take a red marker and redline certain communities, historically underserved communities, Black and brown communities, rural communities, Native communities, and basically say, like, you may not underwrite mortgages, small business loans, personal loans in these environments. So that's why it's called redlining. It's literally marking communities off and saying, like, no, starving them of investment capital. And so the Community Reinvestment Act, CRA, was meant to address that. And I would say the vast majority of Community Reinvestment Act dollars from banks go to CDFIs. They don't go to like underwriting individual community loans. They actually don't want to be in that business. In a way, they're like these trusted intermediaries that can reach, this capillary kind of reach into these hard to reach communities. Anyway, it's very important. And for those of us that care about impact, care about local economic development, that care about Main Street, the hollowing out of rural communities, the starving of the capital starvation of Native communities, CDFIs are really important. And traditionally, the CDFI and the CDFI fund, which is an agency within the Treasury Department that certifies community development finance institutions. It makes grants and offers technical assistance and even bond underwriting for CDFIs. It has been a bipartisan because there are CDFIs in all 50 states, in most congressional districts, and small business is something that funding small business funding community economic development has broad bipartisan appeal. What has happened more recently is that there was an executive order targeting the CDFI funds, and realized, like, if CDFIs can't get certified, then banks will not use their Community Reinvestment Act dollars. If you give to lend to a certified CDFI, you get CRA credit. So just like through the entire ecosystem and the balance to attack by executive order, the CDFI fund. And then during the fall government shutdown, the federal government issued a reduction in workforce, an RIF, to completely lay off all the staff of the CDFI funds. And so a lot of us worked behind the scenes to gather hundreds of Republican and Democratic legislators in Congress to rebuke the administration in a bipartisan fashion and help walk back those funding cuts and reductions in workforce. And it was the first time that I had observed the Republicans in Congress acting as a bloc and rebuking the administration. And it was around one of our core issues, which is community investing infrastructure. I had mentioned in the tax and spending bill that was passed, community, and we also advocated for this on the Hill, the community investing tax incentives be preserved, that some of them be made permanent. These are like new markets tax credits, low-income housing tax credits, opportunity zones. And so this is a cluster of really important policies that have real-world implications for families and businesses around the world, around the country in all 50 states, and needed to be preserved. So this is an area of focus for us. And I think it's a sector that requires ongoing defense, unfortunately. So that's one.
Well, it's great that there was that pushback. I'm just curious, so we don't go too deep on it. But I mean, first to pick up on something you said earlier about, like, I think you said for those of us who care about that impact in Main Street and those local communities, I think and also any investor who doesn't maybe care about the social benefits of all of that, it comes back to that system level investing piece that if those communities are breaking down, falling apart, it leads to, breakdown on, like, well, if there's fewer customers for businesses, there's supply chains can get interrupted, agriculture can get interrupted, and political.
The tax base, taxes go down, local, state and local taxes go down. Yeah, and I think something like at least 75% of GDP is consumer spending. So you hollow out, you decrease the one of the reasons we're focused on income inequality and wealth inequality is that, if you have this consolidation of power up the top, there's only so much the 1% will spend. Like it really becomes a driver of GDP or inhibitor of GDP.
Exactly, and that hurts all investors' portfolios from that system perspective, like we were talking about. Yeah. Just can't help but ask on those cuts, was it just part of the DOGE kind of trying to cut workers in general, or was there a specific reason it was targeted in your D&L, or is it just chaos?
Yeah. So the executive order was targeting the CDFI fund. And I don't think that the administration expected the kind of coordinated pushback among congressional Republicans. And then in the government shutdown, I think it was just an opportunity. It was an opportunity window to further lay off government workers, and which had been kind of a whole set, whether it's DOGE or whether using the government shutdown as an opportunity to lay off federal workers. CDFIs, among many other agencies, were in the crosshairs.
Yeah, gotcha. Well, I appreciate that, because I think the whole community investing conversation is so important. I know a lot of like deeper impact investors and community foundations and stuff lean into it more, but we've had, it's been challenging to get higher ed institutions, endowments to really lean into it, because I think just the way they're structured and the types of investment vehicles that they use and like the geographic, they're looking globally.
But you could make the argument, George, that universities tend to be huge community real estate owners.
Yep.
So there's that as the opportunity, and they have every incentive to support those communities, have them be healthy, thriving communities. And we see in kind of economic revitalization efforts around opportunity zones and others that the role of anchor institutions like universities, like hospitals, is hugely, hugely important. So that may be a way to
Absolutely.
community investing to these folks. And
we've definitely done that with the anchor institution concept, and all these institutions have really strong community engagement activities. They just tend to come out of a different operating budget as opposed to the endowment investing. But we did work with the Democracy Collaborative for some time and their anchor institution initiative to kind of make that case. But where I was going with that is I do think what kind of came out of some of those conversations was that CDFIs are one function where they can kind of put cash and have that community impact without having to do a ton of due diligence or really worry about it. And it's got comparable risk return profiles to other places that might put their cash. They might not be able to put enough of their cash there, given what the CDFIs can handle, but at least a piece. And I think that's something that seems like an easy win for those types of institutional investors to have some community impact without, in ways that fit in with what they're sort of set up to do.
There are these vehicles called CDARs, which have higher FDIC, and they still may not be big enough, but I think that it's like a $5 million backstop from FDIC, and then they syndicate. It's a way to invest, and that they syndicate it to smaller CDFIs. So just
the 250,000 limit or whatever. Because the normal FDIC limit is 250,000, is that right?
Yeah, and I think with CDARs, I'm forgetting community development. I forget what the acronym means, George.
I have too many acronyms.
It's more like 5 million. It's FDIC insured up to 5 million. So there are some other ideas we can take that one offline.
That's great. All right, let's move on a little bit to the freedom to invest attacks, because as you said, this has been kind of growing for the last few years. It seems absurd to me, and the logic it's based on for the most part does seem absurd, but nonetheless, it's getting traction, has a lot of funding in media campaigns and the like, and some wild state level policies that have actually put it into practice. So I guess what's your ideas on the state of the field around all that right now?
Yeah, gosh, it's been a rough handful of years. You'll remember during the 2020 presidential election, a number of the candidates for Republican nomination started talking about woke capitalism. So that was 2020. And into 2021 and 2022, there was a very well-funded, coordinated attack on what we consider to be any pairing of financial considerations and impact considerations. I think, ESG was first in the crosshairs when the Supreme Court struck down affirmative action in higher education. We immediately saw the attacks on private sector actors around racial justice and DEI, investing in DEI practices and the ESG practices of corporations as well.
Yeah.
So that really extended to corporations, asset managers, and asset owners. If I'm being honest, I think that our field was somewhat caught on the back foot, and it took us a while to get our house in order. We had actually been sounding the alarm on the attacks of pairing of financial and impact considerations for some time. I think since probably 2018. There was an antecedent organization called the Main Street Investor Coalition, which was doing a lot of this work early, and I see it as a directly fed into the work of Edward Bloom, and which of course that his group was the one that brought suit at the Supreme Court, Leonard Leo and others. So I think that you mentioned there have been federal and state laws. There have been federal executive orders. I think in some ways, the most egregious state laws one was prohibiting state pension funds from considering even financially material impact factors, which of course means that the fiduciaries would be breaching their fiduciary duty.
Yeah, it's direct violation of they're being allowed to do make a direct violation of fiduciary duty. Yeah.
And the other is the boycott bills, which basically said, for example, in Texas, the state of Texas, they blacklisted 300 plus financial services firms, state, local, national, that considered impact based on, they're basically saying that they're boycotting fossil fuels, but really it was just, you can even talk about climate risk as financial risk. And
yeah, I was going to say that's one of the most egregious examples of hypocrisy. Was on the blacklist. It was the largest investor in fossil fuels in the world in BlackRock.
Yes.
Like,
yes, and so they withdrew funding. You can't use these firms for municipal bond underwriting. And so what was most potent there in pushing back on those was just the economic analysis and the financial analysis to say, you will have underfunded pension fund liabilities if you take climate off the table, if you take other factors off the table. You will have higher municipal bond underwriting costs, higher debt service, interest payments if you do this. What was fascinating is we had some really interesting folks on the same side. So the National Taxpayers Union, which is, lobbies against taxes, raising taxes, was actually against some of these rules because it would mean that taxes would have to be raised in order to fill the gap on pension fund liabilities. The State Insurance Trade Association, State Bankers Associations. And so, when we can make the financial case, I think we end up being on the right side. What was very exciting last week was that Senate Bill 13, which was one of the earliest from 2021, an early anti-ESG bill, was struck down by a Trump-appointed judge, circuit court judge, and was found to be unconstitutional against the First and 14th Amendment. And so I'm sure it will be appealed by Ken Paxton, the AG of Texas and the state of Texas, but it was the first time that it was that one of these bills, one of these more egregious, far-reaching bills, the ones that don't make financial sense, was struck down.
Yeah, that was a big win and good to see. And hopefully these things have peaked, but who knows? And, the other thing is that they've been pushed in a lot of other states and most of them haven't passed, but, some have, but it's just sort of a game, right? These groups are pushing dozens and dozens. They keep coming back and trying again. And some of them kind of squeak through. They don't make sense. Gotcha. Let's move on. I'm cognizant of time here too, but the third category was the backsliding on climate policies in the U.S. And I think, lots of folks working on climate are disappointed about that, but I'm just curious your take, given that, how do you sort of see the market forces counteracting? I mean, we've seen the cost of renewables and storage and a lot of climate solutions come down and just be the better option, and particularly with the AI data center build outs where people need kind of just power at speed, and renewables is a good option for that. What's your kind of take on how much of an impact that the policy backsliding will have?
Yeah, well, you're more of an expert on climate than I am, but I'll share what I'm seeing on the policy side. We're losing ground. I think we are harming U.S. economic competitiveness by repeal of the Inflation Reduction Act, the clean energy tax credits, the repeal of those, or the clawback of the $27 billion, the EPA program that was a greenhouse gas reduction fund, which was a very nice marriage of greenhouse gas reduction, climate considerations, and community climate resiliency. And I think that case will go to the Supreme Court. And then, of course, we have the SEC, corporate and asset manager, climate disclosure regulation clawback. So it's been on a number of different fronts. I see some climate funders, climate philanthropies, rethinking some of their grant-making strategies. We see the market, especially for clean energy investments, feel impeded by these rollbacks, but also by the federal government. So the federal government has put, a halt on certain clean technology, offshore wind, and other types of investments, clean technology investments. So on the one hand, the climate ship has sailed, and on the other hand, we see increasing government intervention.
Yeah, and slowing things down. And to your point, I think the biggest shame for America is just such an opportunity that we're not only letting slip away, but we're actively working against in terms
Handing to China.
in terms of the businesses that can be created, the jobs, the lower cost energy, the resiliency, as you say. So it is a shame, but I do hope this. I think the market forces globally will get there, but it's a matter of time and how much impact there is in the meantime from climate. Well, I want to talk a little bit before we wrap up too about impact measurement and management, which you mentioned a little bit earlier, but I know it's been a big focus for the Alliance as well. And so, I'd just love to hear kind of what you're sort of seeing as the state of play there, and maybe some of the key frameworks that you feel like endowments and foundations should really know about if they're not familiar.
Yeah, so impact measurement and management, or IMM, is a very important pillar of our field's underlying infrastructure. As you mentioned, the Tipping Point Fund on Impact Investing focused on both novel solutions to advance the practice of IMM, but also at times to help consolidate frameworks. I think in our field, there was let a thousand flowers bloom approach. And at some point, we felt that we needed to fund together in order to back some standards and some tools, market tools. I would say our theory of change here is that first we need impact transparency. We need disclosure of impact data. It's an understanding that it is difficult to achieve. It's foundational, and in and of itself is not sufficient. So the idea was to kind of help midwife along impact transparency, and then move to an era of impact accountability. And with impact accountability over time, we hope to have more equitable impact outcomes. So yes, we need clear, comparable decision, useful disclosure from companies and funds. We need, it could be the ISSB standards, as I mentioned. It could be the GINS IRIS Plus. It could be the Impact Management Project's impact management framework. But we also need mechanisms like impact verification, benchmarks, impact-linked compensation. Like, what does good look like? You could just report, but how do you know what good is, and how do we raise the bar over time? And so this raise the bar area, just wanted to give a shout out to IEN's Endowment Impact Benchmark, which is verified by Bluemark, which is another grantee of the Tipping Point Fund alongside IEN. And the benchmark, and you can say it better than me, but it helps institutional investors like universities better measure their progress on their how mission aligned their investments are. And so those kinds of tools like verification, audit, benchmarks, impact linked compensation, we call it like tools with teeth, with impact teeth. That is where we are going to get to the next level of impact accountability, and I hope equitable impact outcomes over time.
Yeah, that's great. It's super helpful, and I appreciate the shout out. I was going to go there myself if you didn't, but the partnership was great to develop the Endowment Impact Benchmark, and it was something that actually came from our members looking to see if they could get some credit for sort of the progress they've made initially, and then we partnered, as you said, with Bluemark, who does the third-party verification. And that just enhanced the value. As we developed this, it was clear that the feedback that they provide to the participants was really valuable. It's almost an advisory consulting role, given their expertise and all the impact frameworks they use and different types of investors they've worked with and verified. They have a good sense, and so that's been a really good tool. And then it gives that ability for endowments and foundations to benchmark their progress against peers, and it's been great. And the only downside is we were ready to really hopefully ramp it up last year when everybody got a little sensitive about being very public around all these topics. So, but we've continued to move it forward. And we're looking at some other partnerships, including with TIP, actually, about how we can expand it, enhance it, and integrate it with some of their tools and frameworks. So that was great. And we're going to keep pushing that out there. Well, Fran, thank you so much for all this. Anything else we didn't touch on that you want to make sure we cover before we wrap up here?
Oh, and I'll try to make it quick because I know we've had a bunch of time together. But one market observation that we have been making but it relates to public policy, is something that we're calling the rise of corporate management primacy. So as you and your listeners would know, there's the long-standing practice of shareholder primacy, as championed by Milton Friedman starting in the 70s, and insists the core purpose of a business, and indeed its social responsibility, is to maximize short-term financial value for shareholders. And it's the so-called Friedman doctrine, has been broadly taken as gospel by the market, but we know is fundamentally flawed because it incentivizes short-term decision-making, it incentivizes externalizing costs like pollution, it disregards other stakeholders, like employees, suppliers, consumers, communities, the physical environment. And so those. Just those. And, not that long ago, in 2019, the Business Roundtable had like over 180 CEOs refresh the statement of the purpose of a corporation to acknowledge all stakeholders. There was this kind of new paradigm that we were excited about, rooted in the principles of stakeholder capitalism. So moving from shareholder primacy to stakeholder capitalism. And even if you look at it through the lens of financial returns, if it's, you could say climate risk is financial risk, historical disparities in income undermine inclusive economic growth. Businesses should be more accountable, et cetera. And, soon after we have this backlash that we've talked about. What I've been observing more recently is this rise of corporate management primacy, where we see C-suites and boards rapidly consolidating, monopolizing power with waning accountabilities to stakeholders, including, by the way, investors. And the hollowing out of longstanding corporate accountability tools and shareholder rights, like corporate engagement, proxy voting, disclosure requests. These are some of the tools by which you would effectuate change in the frame of system-level investing. So these tools are getting taken away. And this rise of unchecked corporate power, I think, demotes shareholders, shifts the balance of power in the capital markets and the real economy, and I think actually makes corporations more susceptible to government interference. And I'm not saying that we're having, the rise of state capitalism, but in the same ways that we saw the shift in the balance of powers between the three branches of government almost real time over the last handful of years, I think so too. We're seeing the shifting of the balance of powers between government, corporations, and investors. And if you don't have investors as sort of accountability counterweight, and we're starting to see this, right? Like, government taking a golden share in Intel. We've seen large media companies, corporations proposing massive mergers, and they might lead them to bend to pressure from the administration. So like CBS ending late night, the firing and rehiring of Jimmy Kimmel. Federal government is taking 15% or more of NVIDIA chip sales to China in exchange for export licenses. So I think something is really
TikTok story. Yep.
Yes. Yeah. I mean, you could add on to the list. And so just wanted to say for your listeners, something is happening here.
Yeah.
And we need to pay attention to it.
It is really dangerous. And again, I think it should be a call to action for investors to wake up to their power and like the necessity, because you see markets that operate like that and they're not typically as thriving or prosperous as the U.S. has been under the Reserve law and good corporate governance. And shareholders and investors have a huge role to play. But yeah, it's amazing. It was a hopeful time in 2019. And I think even though a lot of people had some skepticism around the Business Roundtable statement, it's still a huge statement and a sign of hope, I thought. And then how quickly things changed there. But yeah, I think, investors really need to kind of wake up to that for their own self-interest and their fiduciary duties to push back on that.
Agreed.
Yeah. So yeah, well, thank you for raising that. And let's jump now to our kind of final quick takes. If you could get every institutional investor in the U.S. to do one thing today, what would that be?
Well, okay. For pension funds, I would say to consider value creation more broadly. So most institutional investors are participating in this cycle of extraction, including the destruction of system-level value in exchange for financial value. And I think that, in decades to come, that is a gamble that will not pay off favorably. And for foundations, too, as another, type of institutional asset owner, to internalize that philanthropy is the runoff of a broken system, and that endowments as they are currently managed are often unconsciously complicit. And so they're squeaking out some dollars at great pains to fund grant payout. But it's an inefficient way to create value. So I would say reconsider value creation more broadly for institutional asset owners.
Mm-hmm. Love it. How about a book, podcast, article, or other resource you'd recommend?
Yeah, so this one has been mentioned before. I really like Beyond Modern Portfolio Theory for those interested in learning more about the system-level frame by John Lekomnick and James Hawley. I love your podcast, George. I've been listening to it quite a lot recently, and also the PRI podcast, which is called Principles for Responsible Investor Podcast. It's called The Responsibility of Investing.
Mm-hmm. Nice. Good one. And how about on a personal level, what do you find you doing in your free time?
A little hard to come by in New York City, but I love nature walks. When I lived in LA, I played a lot of beach volleyball, so I'm still trying to find my sport in New York. But yeah, that's when I do a good time.
Very cool. Awesome. And then our final questions we ask everybody, what's your vision for the future of finance? And I'm sure you could write a book on this, but try and...
You could write a book on this. Well, it just builds on what I said earlier, that investors need to interrogate the nature of value and modernize fiduciary duty as a result. And governments and markets need to price and internalize externalities. We talked about foundations make money over here and give grants over here. Well, the entire system by which value and money moves, I think, is broken. And corporations in many instances have had a free ride on the back of stakeholders. And so I believe that needs to be revisited.
Yeah, that's a great point. And I think it's an interesting one because people will ask, why it's been working. It's done a lot of good things over the years, which is totally true. I think we should recognize that. But we're coming up against planetary boundaries. We're coming up against these sort of social limits. And we got to reevaluate, fix it. How about advice you might give to college students or young people interested in careers in this space?
There was a piece in Impact Alpha, which is our kind of a trade rag online. Some of the content is behind the paywall, but recently Sean Cole, who's a professor at Harvard Business School, did a survey of Impact Capital Manager ICM Mosaic Fellows. And he combined that with an earlier analysis of 350,000 impact investing career profiles and has some really interesting findings that would be worth checking out. But what I always say to students when I guest lecture is be clear about your desired proximity to impact. So if you are someone who gets energy and feels like you want to be on the ground in Nairobi or Detroit, you need to honor that. You would not be happy working for me because I am very far from that impact, but we're working with very high leverage tools. But I came from doing work for and with impact entrepreneurs and then became a fund manager and then was investing in funds and now I'm doing this work. So think about your desired proximity to impact and honor that.
That's a great point. Yeah. Yeah. That's one I think about a lot too, because we are working quite far upstream and what we're doing day to day is a lot of this, a lot of reading, a lot of meetings, a lot of conferences. And it feels far away from the impact sometimes, but it does take people at all kind of parts of the system working on this stuff. So that's a great point. It's not a blanket one size fits all kind of advice. Nice. Well, Fran, thank you again so much for taking the time to do this. It's great to catch up as always and hear your latest thoughts. And I hope we get to catch up again soon.
Likewise, thanks for the opportunity, for the conversation, and looking forward to continuing it.
Absolutely. Take care.
Take care.
Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.